Silver at $80 per ounce. If I told you that number could one day look as insignificant as $5 seems today, your instinct would be to dismiss it. But stay with me. I am not asking you to accept anything on faith. I am going to walk through the arithmetic, the historical record, the institutional research, and the physical supply data. By the end, $300 silver will not seem unreasonable. You may find yourself wondering whether that number is too modest. Here is what we can verify today, April 21st, 2026. Silver reached a nominal all-time high of $121.64 in late January. It then fell 44% to $67 and has since recovered to the $80 level. Meanwhile, an active military confrontation over the world's most strategically vital oil shipping corridor continues to unfold. Most observers see that and perceive disorder. Institutional capital reads the same data and arrives at an entirely different conclusion. They see a physical commodity in its sixth straight year of structural supply deficit. They see industrial consumption powered by solar, EVs, and AI, three sectors whose growth is essentially irreversible. They see a Federal Reserve constrained by oil-linked inflation, a headwind that becomes a powerful tailwind the instant that pressure subsides. And they see $80, still 34% below a record high that was likely just the beginning. This is for educational purposes only. Silver is extremely volatile. Nothing here constitutes financial advice. Now, two beliefs many viewers probably hold. First, that silver's story is too complicated and the opportunity is past. Second, that the drop from 121 to 67 confirms silver was a bubble now deflating. Both miss the point entirely. The decline was not caused by deteriorating fundamentals. It was a mechanical event. Margin calls cascading through leveraged positions, algorithms triggering stop losses, monetary policy repricing, and paper contracts liquidated on massive scale. The physical world, the mines, factories, solar installations, data centers, EV plants, none changed trajectory. The silver market still recorded a deficit of roughly 67 million ounces in 2026, even as the paper price collapsed. What we witnessed was a paper derivatives correction, while an unresolved physical shortage continued underneath. History is precise about what follows that divergence. As of this morning, silver quotes near $79.50 to $80, roughly $2 below last Friday's peak around 82. The pullback has a direct cause: fresh naval confrontations over the weekend in the Gulf of Oman, with the U.S. intercepting an Iranian vessel and Iran reinforcing near the Strait of Hormuz. When strait tensions rise, oil rises, inflation expectations climb, markets assume the Fed holds rates higher, and silver faces resistance. But this pullback is occurring within what was a historically significant macro week. Last Friday, Iran declared the strait would remain open during the ceasefire period. Oil fell over 10% in a single session. The dollar dropped nearly 3%. 10-year yields declined to 4.23%. For the first time since March, bonds began pricing in rate cuts before year-end. Silver surged from 77 to above 82 in days. What you are seeing this morning is short-lived geopolitical noise within a broader macro transition shifting in silver's favor. The dollar is softening. Rate expectations are tilting toward accommodation. The physical supply picture has not changed by a single ounce. To understand why this matters, you need to understand silver's fundamental mechanism. Silver is a non-yielding asset. Its competition is yield-bearing instruments, treasuries, money markets, deposit accounts. When the Fed raises rates, the opportunity cost of holding silver increases. When rates fall, capital migrates back toward tangible assets. Overlay the currency dimension. Silver is priced in dollars globally. A stronger dollar suppresses international demand. A weaker dollar expands it. Both forces, rates and the dollar, are now trending in silver's favor. And here is what most analysis neglects. A widening gap has opened between the paper price and the physical price. COMEX registered inventories have fallen to critically thin levels. China restricted silver export licenses in January. Lease rates for physical delivery have surged at multiple points this year. The paper price can be manipulated short term. But every time in history that paper has deviated significantly from physical reality, the paper price was eventually compelled to realign. That realignment tends to be abrupt and dramatic. Now, the supply-demand picture, the single most important concept for silver in 2026. The Silver Institute confirms this is the sixth consecutive deficit year. For 6 years, consumption has exceeded total production from all sources. The 2026 shortfall, roughly 67 million ounces. Cumulative depletion since 2021, over 762 million ounces. Nearly 750 million ounces drawn from finite reserves. Supply cannot expand to meet demand. Approximately 70 to 80% of silver production is a byproduct of copper, zinc, and lead mining. Silver output is governed by the economics of those primary metals, not by silver's price. Mine production in 2026 is forecast to grow roughly 1% to 820 million ounces. Total demand runs near 1,050 million ounces. The math does not balance. 3 industrial sectors are driving acceleration, and none is reversible. Solar energy consumes 194 to 230 million ounces annually, with installations growing 15% per year. Even as manufacturers reduce silver per cell, total consumption stays elevated because volume growth outpaces per unit savings. Electric vehicles use 1 to 2 ounces each across battery management, sensors, and charging systems. At 15 million units this year, that is up to 30 million ounces, with projections showing autos could reach 59% of industrial silver usage by 2031. AI data centers require silver for servers, power distribution, and thermal management. Silver has the highest electrical conductivity of any element, and it constitutes such a negligible fraction of data center costs that buyers are completely price insensitive. No tech company will slow its AI build because silver costs $80 instead of $30. That is textbook inelastic demand. None of these engines is cyclical. Solar mandates are legislated across dozens of nations. EV adoption is a multi-decade transformation. AI infrastructure is this decade's defining investment. Silver cannot be replaced in these applications without performance degradation. Now the historical record. 2 episodes demand attention. In the 1970s, silver went from $1.50 to $49.45, a 3,200% advance over 9 years. Driven by structural inflation, the oil embargo, a Fed struggling to restore credibility, and a dollar losing purchasing power. Sound familiar? From 2008 to 2011, silver went from $9 to $48.70, a 440% advance, driven by zero rates, quantitative easing, a weak dollar, and emerging solar demand. Every phase was dismissed as speculation. Then silver eventually reached $121 in 2026, 1,250% from the 2008 low. This is what silver does under favorable conditions. It stays quiet, absorbs selling, gets dismissed, then moves in a way that permanently separates those who understood from those who did not. Now the price targets, built on verifiable arithmetic. The gold to silver ratio currently sits around 60 to 1. Gold trades near 4,800. Historically, the ratio averages 40 to 60. In peak bull markets, it compresses hard, 17 to 1 in 1980, 32 to 1 in 2011. Gold at current levels with a 40 to 1 ratio gives silver at 120. Gold at 6,000, ratio at 40, 150. Ratio at 30 with gold at 6,000, 200. Gold at 8,000, ratio at 35, 228. That is the conservative scenario. $150 to $300, using nothing but documented ratio behavior. The 300 to 500 range requires layering in currency debasement and sovereign debt dynamics. U.S. debt exceeds $38 trillion. The IMF has formally warned that debt trajectory is eroding Treasury safety premiums. Interest payments are projected to become the largest budget item. When markets question a government's capacity to service debt without money creation, currency confidence deteriorates and tangible assets reprice. This is elementary monetary history. Global silver investment demand is projected to rise 20% in 2026. ETF holdings stand at 1.31 billion ounces. Layer dollar depreciation of 20 to 30% over 5 years onto ratio arithmetic. Gold at 8 to 10,000, ratio at 25 to 1, and you get silver at $320 to $400. Add the intensifying physical squeeze and accelerating industrial demand. 300 to 500 has historical precedent, institutional backing, and a structural engine behind it. The 500 to 700 range. If silver replicated the 1970s percentage advance from its 2020 low of $12, a 3,000% move, you reach 360. The current cycle has already produced 900%. If it matches the full 70s magnitude, the terminal point is roughly 396, and we have not reached the midpoint of the macro shifts driving this. 500 to 700 requires 4 factors converging: a genuine dollar confidence crisis from debt dynamics, physical shortages deepening below critical thresholds, triggering industrial hoarding, the Fed forced into significant rate cuts by recession, and sustained geopolitical instability, channeling capital into tangibles. This is conditional, not a forecast. But the math from ratio analysis, historical percentages, and debasement modeling all converge on that zone. In 2020, would you have believed $121? Here we are. The geopolitical situation. The Strait of Hormuz handles 25% of global seaborne oil. 2 scenarios matter most. Escalation. Ceasefire fails, oil above 100, inflation surges, silver faces near-term pressure towards 72 to 74. But in sustained stagflation, silver's monetary role eventually overrides rate sensitivity, exactly as the 70s showed. De-escalation. Peace deal, oil retreats, Fed signals cuts, dollar weakens, silver likely passes 80 quickly and targets 90 to 95 within weeks. In both scenarios, the 12 to 18-month outlook tilts constructively. Only the path differs. Key levels this week. Upside, 82, 83.60, 88 to 90. Downside, 78.50, 77, 72 to 74. The critical confirmation is a daily close above 83.60, the psychological reality. Most investors who experience the drop from 121 to 67 are hesitating. They need 85 to feel comfortable, 90 to feel assured, 100 to believe. By the time the average participant feels safe, the accumulation phase has concluded. The risks, because honesty requires it. We have already seen a 44% decline this year. Even in a legitimate bull market, silver can correct 30 to 50% at any point. The geopolitical situation could stabilize faster than expected. The Fed could surprise with hawkishness. Industrial demand could weaken in a global recession. Silver reduction technology and solar could accelerate. And timing risk is real. You can be right about direction and wrong about timing if volatility forces you out before the move materializes. Size your allocation appropriately. Never commit what you cannot afford to lose. This is not a short-term trade. It is a long-duration conviction position held through significant volatility. The conclusion. At $80 beneath the surface sits a 6th-year supply deficit, industrial demand from solar, EVs, and AI accelerating with no signs of slowing. A geopolitical crisis simultaneously pressuring and eventually enabling a macro release. A Fed navigating impossible trade-offs, and a dollar confronting debt levels the IMF has formally flagged. Institutional targets range from $135 to $309. The conservative math produces $150 to $300. The expansion scenario produces 300 to 500. The extreme but coherent scenario produces 500 to 700. In 2020 at $12, did 121 sound possible? Now consider what has changed since then. More debt, more instability, more currency pressure, more shortage, more demand, more institutional attention, and silver is still available at $80. The physical world is running short of silver. Industry needs more each year than mines produce. The macro environment is slowly but unmistakably moving in the direction that historically launches tangible assets into extraordinary advances. At $80, is this early, or has the window closed? That question may be one of the most consequential financial assessments of this decade. If this offered a framework conventional media does not provide, subscribe. Share it with someone who should understand what is happening in the silver market. And drop your silver price estimate for end of 2027 in the comments. I suspect those paying attention now will have a very different perspective in 2 or 3 years.